The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Treasuries trade Iran, driving the market action for yet another day. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Alex Steele. We're kicking you off to the closing bell right here in the U.S. It's still muted on an overall index level, though, at the end of the day. Let's take a look at where markets stand. You got the S&P up just 0.3%. Not a ton of movement. It's been a little directionless over the last week or so, despite the data. There is a bend to the bond market, very strong. You got a super solid 10-year auction, that 2-year yield down by about 4 or 5 basis points. The big story, though, here is the dollar, down 0.6%. The Bloomberg Dollar Index remained the lowest level since 2022.
And I think that's really where we want to start, because as has been the norm of late, most of the cross-asset price action can be found in Treasuries and in FX, both batted around today by competing headlines on trade, on inflation, on Iran. On trade, it was Trump floating new threats of tariff action. On Iran, Israel said to be mulling fresh threats of warfare. And on inflation, a tame report on the wholesale prices that producers have to pay out. Now, that confluence together with jobless claims jumping to the highest since 2021, that did help to push the dollar down further. Yesterday, it was at its weakest since mid-2023. Today, it's at its weakest since mid-2022, beaten out by every currency imaginable today. The Swedish krona, the Korean won, Swiss franc, the euro, yen, pound, peso, real. That's feeding into the Treasury moves and feeding into renewed bets for monetary policy easing.
The easiest long-term trades are, you know, the yield curve's going to steepen probably to historic wides. You know we're going to cut short-term rates dramatically in the next year. And you know the dollar will probably be lower because of that.
Absolutely. And a relatively strong auction of 30-year government bonds today, holding back the curve, steepening just a touch. And while all this did stir up volatility in equities, ultimately, stocks remain pinned in a tight range, the range that they've been in for the past week, with peak-to-trough moves over just the past 8 sessions of only about 138 points. The S&P today clinging to that 6,000-point line in the sand.
All right, well, speaking of kind of both of those items wrapped up together, you take a look at this chart. It's the Bloomberg Dollar Index versus the 10-year yield. And you can see ever since Liberation Day, so the beginning of April, the divergence where the dollar just continues to grind its way lower, whereas the 10-year yield grind its way higher. And I guess my question is, how long can that separation actually last? Does the yield have to come down to really wind up meeting the dollar? Or are we in a structural change here where you have maybe the back end of the curve really responding to, say, fiscal deficits and jumpy anxiety versus the dollar, which is also dealing with the change of U.S. exceptionalism? Yeah,
we have the dollar already down 8% or so to start the year. I can't even remember the last time we had an annual drop of that magnitude. Let's see how it works out, particularly when it comes to the other cross-asset price action. Bill Campbell joins us right now to kick us off to the close, Global Bond Portfolio Manager at Doubleline. Bill, great to see you here. Let's start with the dollar here. Weakness once again. This wasn't necessarily a surprise coming into this year. I know a lot of people had bet on some material weakness in the dollar. I'm not sure they bet on this much weakness in the dollar. And the big question is this temporary, or should we just kind of prepare ourselves for a longer-term structural shift lower?
Romaine, thank you for having me on. I don't think I'm going to argue with Paul Tudor Jones on this one. I'm going to add actually an additional factor to his view that this is a longer-term structural trend lower in the dollar, likely over the next several years. Beyond just the easing inflation data and softening employment data, bringing forward the potential for Fed cuts, maybe to the fall or at least the end of this year, I would say that the real fuel underlying the structural view that the dollar can go weaker over the next several years is the unwinding of all the foreign investment that's come into the United States over the past 2 decades. And, more specifically, we've seen a ramping up of foreign investment over the past decade. Yes, we've had U.S. exceptionalism with high growth rates compared to other developed markets, with higher earnings growth rates relative to other developed markets and higher multiples. And what that's done is if you look at the BEA data, it shows that today, or as of the end of 2024, which is the latest data available, there's $62 trillion of foreign savings sitting in the United States in one form or another, whether it's portfolio investments, direct investments, or or an additional investment such as real estate. Now, the first part of this dollar move that we've seen this year, in my opinion, is more driven by foreigners hedging all of that investment in the U.S. For the past decade, they've had the luxury of a relatively strong dollar, keeping the need for FX hedges relatively low. And that's been good because FX hedges are costly to foreigners. Currently, most foreign countries are looking at FX hedging costs between 2% and 4%. But now with the dollar trending down, those FX hedges have moved up. We saw the Taiwan lifers, it looked like last night, increasing additionally their FX hedges. But that's just the first part of the move, Romaine. I think that there is a lot of runway for this, for the dollar to move lower over the coming years.
What about with Treasury yields? And I mean, if that is what's occurring with regards to the impact on foreign investors, what becomes the effect on Treasury yields?
What a great question. And Alex had set this up nicely with a wonderful question as to, is this a structural break between higher Treasury yields and the lower dollar? And quite frankly, we at Doubleline would answer yes. We do think that there is now a fundamental structural break happening. Not only is there going to be some reallocation, even if it's small, of that 62 trillion, that's a very large number when put into market context of foreigners, holdings of U.S. assets. But we also believe that the additional fiscal pressures, which have been very well covered, have increased term premium and will continue to do so. But one item that has been losing some of the headline attention is that both the Fed and global central banks continue to reduce the size of their overall balance sheets by purchasing less government securities. They're less involved, in global government bond markets. That also increases the need. So not only do we have increased supply, but we have a price-insensitive buyer that continues to step back in global central banks. And we think that this is a situation that doesn't have an end in sight, not only with the U.S. bill, working its way through Congress right now, seeming fairly large, but the U.K. is bumping into similar issues, Europe as well, where you're seeing the need for increased infrastructure and defense spending, and then also Japan.
So, Bill, and that's in essence also why we're seeing a lot of central banks buy gold at the end of the day. All right, Bill, so give me your best investment thesis with this in the backdrop.
So what we're advising investors to do is, one, don't panic. We like, and I might borrow from your clip of Paul Tudor Jones at the beginning, that we also believe that the curve will continue to steepen. We think that eventually the moderating inflation and softening labor market allows the Fed to cut interest rates, but that term premium, as we discussed, keeps back pressure to push back-end rates higher, and that's going to be a global phenomenon. So we like investing across developed market global government bonds in the belly to maybe the 5 to 10 year sector at most, but more in that front end to the belly of interest rate curves. Secondly, we're talking to investors about thinking on pullbacks or when the dollar increases, adding to international exposure. We think that over time, international exposure is going to benefit U.S. portfolios, and that's going to provide a decent diversifying offset in global fixed income portfolios going forward. And then for the time being, we still are favoring higher in quality credit trades as credit spreads remain very tight. It remains difficult for us to allocate too aggressively to lower yielding or credit opportunities.
All right, great stuff, Bill. Great insights out of you and really everyone over at the Doubleline team. Bill Campbell, Global Bond Portfolio Manager at Doubleline, kicking us off to the close. When we come back, a focus on those inflation numbers, CPI, PPI, both coming in over the last 2 days. Cool, like the other side of the pillow. A conversation with economist Veronica over at Citi.
That's funny. All right, plus we power through with NRG Energy CEO Larry Coben. He joins us to discuss how his company is going to manage that surging demand driven by AI.
And a little bit later, we're going to focus deeper on AI and tech with Adobe earnings after the bell and a conversation with the co-founder and CEO of Life 360. Of course, that's the owner of the Bluetooth tracking device Tile. A lot of other location services there. You don't want to miss that conversation. Stick with us. This is The Close on Bloomberg.
Economic data of the morning, recurring jobless claims jumping to their highest level since 2021. Now that, along with softer producer price inflation, pushing yields lower, dollar lower. Some saying that potentially the Fed could now speed up its rate cut timeline. Joining us now is Veronica Clark, U.S. economist at Citi. Veronica, does this help? First of all, is this sustained disinflation?
So I think it's too soon to see the tariff impact on inflation, but I do think there is a sustained disinflation and that it is a very positive sign that we were going into this tariff period with an even faster slowing in underlying inflation than we were expecting. So we got the May, of course, inflation data this week. It was really soft across the board. We're getting another 0.1% increase in our for core PCE. That's a really soft increase in core PCE inflation. The Fed's going to be really encouraged by that before we see any of these tariff impacts.
So from that perspective, should the Fed be cutting sooner rather than later?
Yeah, I think they're still, unfortunately, in this wait and see mode. I think that's what we're going to hear from Chair Powell next week. I think that's probably what we hear from them in July, but we do have more data to go before we get to that July FOMC meeting, another jobs report, another inflation report. But I think as we're getting into September, they're certainly going to be cutting then.
I am curious to us about some of the survey data. We've made a lot of hay about the consumer sentiment data, either from the Conference Board or from UMich. We get an update on UMich tomorrow. And I'm curious, we've started to see a little bit of an uptick in some of those sentiment readings, both for consumers as well as small businesses. And I'm wondering, given that some of the tariff rhetoric is tamped down, or certainly not at the crescendo that it was just a few weeks ago, is that going to be enough to at least get people more comfortable with the idea of spending and more comfortable with the idea of where they think their lot in life is?
Yeah, that consumer survey data, it has seemed very sensitive to tariff-related developments. That University of Michigan survey in particular, it does seem like it's gotten more volatile after it had a methodology change last year. We have seen it improving even in some of that May data, after tariff delays. So maybe we see more of that in this early June data. But in general, it's just really not a great indicator for how people are actually acting. It's not necessarily a great indicator for how they're spending. And for that, I would look really more to the hard data on labor market conditions. And that's where these claims data this morning is a pretty important story. It does look like the labor market is loosening. I would think that has a bigger impact than sentiment on how people are spending.
So the 4-week moving average on those claims right now around 240,000. Is that above norms, below norms? Where does that? Give me some context.
Yeah, initial jobless claims, they're a bit higher than we've seen them for a lot of this year, but that level, around 240, 250, that's not necessarily a concerning level yet. I think as we were getting closer to maybe 260, maybe higher than 260, certainly if we're getting closer to 300, that would definitely be more concerning. But I'm actually more concerned about this increase in continuing jobless claims. That is a higher level, and I think that's telling us that if you do happen to lose your job, you're not quickly finding a new one. It's already been the case for the last couple of years that hiring has been very low. This looks like hiring that has maybe taken another leg lower. And that in itself could mean higher unemployment, a rising unemployment rate.
I also wonder how much of that is companies just staying on pause because of tariff uncertainty. And if tariff uncertainty gives way to certainty, does the foot go on the accelerator?
Yeah, I think a lot of it does probably have to do with uncertainty. But unfortunately, if we're waiting for tariff certainty, we're probably waiting a while, right? We're still, and we still don't know where the ultimate tariff rate is going to end up. Maybe people are feeling a bit more confident that they're not going to be these high, disruptive rates that we got on April 2nd. But it does anecdotally still seem like businesses are pausing investment, pausing hiring plans for now. And this was already a labor market with very low hiring. And if you're still trying to cut your labor costs, at some point, the last option might be to have some bigger layoffs.
Right. Before we let you go, Micron said that today it's going to plan to invest about $200 billion in semiconductor manufacturing. And I'm not going to ask you about the company specifically, but the idea that companies are making these big announcements, GM also did something similar. What is usually the time lag from announcement to shovel in the ground?
Yeah, it is very impossible to know. Unfortunately, we get these headline announcements, and it's really hard to translate that into any kind of growth forecast. One, we don't know what kind of investment would have happened anyway. Are these just headlines, to spark some optimism? Maybe things would have been happening anyway. So how much more of a boost to growth is this? It probably does take, a number of quarters, maybe years to start to see it show up. This is also, presumably nominal investment, and maybe with higher prices, there's less real investment. So just really hard to know how these translate to a higher growth trajectory. And we're really not going to probably see that in the next quarter or two.
All right, Veronica, always great stuff. Veronica Clark, economist over at Citi. Remember the next two big data points that you missed data tomorrow on Friday, and retail sales in the middle of next week. When we come back today here on the big program this Thursday, we await those results out of the home furnishings retailer RH. We're going to give you a preview of what to expect. That's coming up next. This is The Close on Bloomberg. All right, time now for our top calls. Big movers on the back of analyst recommendations. And we start off today with Oracle. Melius Research, which had one of the lowest price targets on the street at $163, boosting that to among the highest at $230. The analyst says the outlook for Oracle is looking bright after the software company's earnings beat expectations thanks to strong demand for AI infrastructure. A 14% gain on the day to a record high. Next in line, Tapestry. TD Cowen raising its recommendation on the company behind Coach and Kate Spade to a buy and lifting the price target to 100 from 90. The analyst sees the Coach brand securing its bag as it continues to attract more young customers and to expand its presence in Europe. That stock up for a fourth straight day. And finally, United Natural Foods. North Coast Research downgrading to neutral, this amid the fallout from a recent cybersecurity breach. Now, the company is the main wholesaler to Whole Foods grocery stores, and the cyber attack has knocked the company's systems offline and is still disrupting deliveries. Those shares down 2.5% on the day, but they're down 23% over the past 4 days, now to their lowest levels since November. Those are some of our top calls. All right, we do want to stay in the consumer space and, well, take a look at the luxury consumer. All eyes on RH, the luxury home furnishings company set to report earnings after the bell tonight. Expectations are high, but a lot of questions here about the health of the consumer and their ability to keep buying. Brian Nagel joins us right now to preview those results. Senior equity research analyst at Oppenheimer. He's got a market perform rating on RH. Revenue coming in at about $820 million. That's the consensus on the street. The company, though, still expected to post a loss for the quarter. Brian, what are your expectations out of this company? Are we looking for revenue growth? Are we looking for some meaningful turn in profitability? What?
Well, good afternoon. Look, it's going to be a very interesting report, okay? And the numbers are going to matter. But I think what may matter more is just the commentary around this quarter and what RH sees. Because like you said, your opening, I mean, this is a very good read on the health, if you will, of the higher end consumer. Okay, so what RH says about demand trends through the quarter, what they're seeing here in the second quarter, I think is going to give us some insights into that again, demand trends for the higher end consumer. The other big topic is tariffs, global trade policy. I mean, it's maybe it's settling down a bit lately, but it's been an extraordinarily fluid situation. RH, like other home furnishings companies, imports a lot of product. Okay, and so they're going to be talking about what they're seeing from a tariff perspective, their mitigation efforts, et cetera. So I think really what's going to matter here most is the commentary, and it's difficult to handicap that. Okay, go ahead.
Yeah, no, I am curious about this too. And I mean, one thing about RH, one reason why we like covering it too is the CEO, Gary Friedman, tends to be pretty vocal about macroeconomic conditions and trade policies and things like that. Is this a company that has the ability to mitigate the impact of tariffs, either absorbing the costs itself or passing those costs on to its end consumer?
No, look, it's a great question. So, I mean, this is the conversation I'm having with almost every company I cover at this point. So we think of RH, and kind of, within this tariff framework, look, given the high price point, given it's a high-end consumer, a unique item, there's probably pricing power. What that basically means is that RH has the ability to, raise prices to the extent they need to. They also, given their position as a unique player in the high end of the market, they probably have some leverage or decent amount of leverage over their suppliers, so they could pass these costs back to their suppliers as well. So RH should be a company that should be able to manage through the tariff dynamic pretty well.
Then you look at, say, Williams-Sonoma. They should have also done well after earnings because their numbers held up really well and the stock took a hit. Are we going to be in the same kind of setup for an RH?
Well, I mean, look, I think Williams-Sonoma had a good quarter. In fact, I was talking to their management team.
But the stock went down.
Right, but so if we just kind of separate for a second the fundamentals in the market reaction, right now the market's reacting funny, if you will, to some of these reports, and a lot of it's okay. We got a good report out of the way. What lies next? I think Williams-Sonoma, again, it's not a name we're necessarily recommending here, but I think there you're starting to see an improving fundamental trajectory, and it made us take the time for the market to realize that.
Now, clearly with RH, there's some long-term opportunity expanding overseas, also in terms of, say, hospitality, et cetera. But what's the margin picture for that until we really get the pickup down the road? Well,
look, it's a good question. I mean, so RH is, they have a global footprint, right? They're pushing to a lot of businesses. I mean, the businesses you mentioned are generally speaking going to be lower margin than their core domestic home furnishings business just because they haven't scaled yet. So especially right now, with this precarious, if you will, backdrop, I mean, that's a challenge for the company. I mean, I think they've got to be asking whether they continue to invest in these projects that you may not see substantial profitability for some time.
What do you think about their strategy of becoming a little bit more, I don't know if it's hospitality or services or what the right word is, but you're talking about a company that's moved into restaurants, hotels. They've kind of made it clear that they want to be more than just a furniture retailer. Is that a good strategy?
Well, I mean, look, I've written a lot about this. I mean, it sounds great, okay? And I know, the CEO of RH, again, very talented executive, talks a lot about companies like LVMH, some really powerful global brands. As an analyst following, domestic consumer, I would much prefer that RH focus more on its domestic business, which I think it does a nice job. But what I've seen too many times are companies like this where they have a very good core business, but then they have these aspirations to be much more. And what happens is it really dilutes the efforts. And that's one of my bigger concerns here of RH.
All right, Brian, really appreciate it. Thanks very much. Looking forward to those numbers. Brian Nagel is Managing Director and Senior Equity Research Analyst at Oppenheimer.
And I just want to point out, too, I kind of forgot. Remember when they reported last time? That share dropped 40%.
Oh, yeah.
Okay, yeah. I forgot about that, yeah.
You forgot about that?
I did.
So the ongoing joke is that Romain loves RH for many different reasons. I think he's like a secret member of their RH club.
We'll
yeah?
see.
No?
Do you want to come?
Yes. Are you inviting me?
No, I'm not a member.
Oh, he's so a member. All right, coming up, we're going to talk to Larry Coben, President and CEO of NRG Energy, about how AI is causing a surge in energy demand and how it's going to impact the power industry and his business. This is The Close on Bloomberg.
And we have so many plants being built right now. It's so beautiful to see. And one of the reasons they're coming here is because they have to produce tremendous, especially the AI, they have to produce beyond believable amounts of electricity.
3:30 p.m. here in New York, and that was the President of the United States speaking a little earlier down in Washington, Romain Bostic alongside Alex Steele. And I think that last line there, I think, really sums up a big part of what we've seen in the markets over the last few months.
Oh, absolutely.
Yeah.
And we've seen it in deals also. We saw Talon Energy reaching a deal with Amazon Web Services to provide power. We also saw that with Constellation and Meta, Constellation and Microsoft. We don't really know, though, in terms of pricing, if they're comparable or what these kind of contracts are going to wind up looking like or how easy it is to get these contracts. contracts done, but we're seeing them.
And it's a rush to find other alternatives as well. We talk a lot about nuclear power, nuclear, Oklo, building these small
modular reactors.
Reactors. So people looking for options.
Looking for options, and we have a CEO of a company also looking for options right here. Larry Coben is president and CEO of NRG Energy, a company that generates electricity, providing energy solutions of natural gas to millions of customers across the U.S. and Canada. Good to see you. Thanks for being here.
Pleasure to be here.
Where are your data center deals?
They will be all over the country.
Okay, when are we going to get them?
Well, you're going to get a fulsome update on our second quarter call.
Okay, good tease.
And so, you'll have to invite me back the day after so that I can, talk about them in detail. How's that for begging my way back on?
Yes.
But look, these are complicated deals. There's huge deals out there. I think people now, every time there's not a data center deal for a month, people wonder if they're real. But now that we've seen the last two, they're clearly real, but they're complex. And so they take time to put together. And, you have to decide when to disclose them, too, because even when you talk about them, there's still a couple steps left before they're actually done.
I'm curious about all of the attention right now on nuclear and what energy's role, if at all, would be in that space. Because when it comes to data center demand, there are a lot of people that have talked about the stability of nuclear power and powering those centers.
Look, there is not enough nuclear power in the country, full stop, to power data centers. And so, from the beginning, we've known that, nuclear power some of those deals may come first, but that gas is going to be an integral part of that. We're seeing that every day. If small-scale nuclear reactors become a commercially viable technology, which I hope they will sometime 2035, 2040, we would certainly look to do that. But this is going to be things that are powered by everything, because there's simply not enough electricity in the U.S. grid to power everything with nuclear power. And if remember also, if you take the nuclear power off the main grid, somebody has to supply the people who were buying the power from the nuclear plant before. It's it's not as if by moving it away, you've all of a sudden got new capacity.
I am curious about the geography of that and how close you have to be to those sources, about the idea of sort of moving that power from sort of one region to another. I mean, how cohesive can that be?
There's really two kinds of transactions. One are kind of co-located when you're on one of the power plant sites and you're selling power from next door. But honestly, that's not going to be the majority of the transactions. The majority of the transactions are going to be, you're going to be somewhere on my grid with your data center. My power plant will be somewhere else on the grid. Maybe a new plant, maybe an existing plant, and then I'll be selling you power the same way I sell power to commercial and industrial customers all over the country today.
They're just virtual power purchase agreements, so you have some clarity on financing, basically, at the end of the day.
Right, clarity on financing and clarity on supply for the data centers, obviously.
Okay, so you guys just did a $12 billion deal for a fleet of gas-fired plants from LS Power Equity Advisors, right? So that
Correct.
Feels like a buy versus build scenario. It takes a long time to build stuff.
Yeah.
What's next?
I think we're going to do both. I mean, I think the LS Power deal doubles the size of our generation fleet and gives us metal in a lot of different jurisdictions where we didn't have it before, so we can have more creative and longer-term solutions, both for data center users, but also our regular customers. But remember, we also have an arrangement with GE Vernova and Kiewit for construction and turbine slots. But some people are going to want new and dedicated power plants. Some jurisdictions are eventually going to say you can't take power off the grid long term unless you replace it. We're all about building optionality in menus for those customers. And we think we've done a great job at doing that between the LS Power deal, the GE Vernova Kiewit deal, and some other things that we're working on to give us additional optionality for data center service.
And you guys sold out of nuclear, right? And I'm wondering if small modular reactors for the future, because you can't build that tomorrow, right, if that's going to be something you guys are looking for.
Well, I think when they are commercially viable, we are happy to. We are kind of technology agnostic. We only had 44% of one nuclear plant, so we didn't have the ability to dispatch it. That's why we sold out of it, because it wouldn't work for any of these sorts of strategies. I was on a panel in 2013 where I was told small nuclear would be the thing in 2020.
I know, me too.
Yeah, maybe it was the same panel. I think I bet the person $100 it wouldn't be in 2020, and then double or nothing for 2030, and I'm going to win both bets. But eventually, small nuclear reactors and big nuclear reactors, because at the end of the day, you need one regulatory regime for your nuclear fleet. That'll be part of the solution. But it's not going to be all nuclear. It's going to be geographically dependent and customer dependent. So I believe we're going to have it. We're going to have gas. We're going to have nuclear. And by the way, we're still going to have solar and wind and hydro and batteries. I mean, those businesses are having a tough time at the moment, but they're an integral part of the solution as well.
I am curious about regulatory policies out of Washington and whether they're going to be supportive of that, particularly on the last couple of points you made with regards to solar, wind, some of those renewable energy sources.
Well, that's a great question. I wish I knew the answer. I might be in a different business.
Yeah.
Look, I don't know what's going to come out of this particular bill, but longer term, the market is going to decide what happens here, and that's what's going to drive this. I mean, people forget that Texas has twice as much renewable power as California, and it doesn't provide the same incentives that California does. And so, but that's market driven. So markets will drive this more than anything else.
How hard is it? Okay, but markets still need help, I think is the point, right? So do you think that if we remove help for some of these energies, that it's going to take either that much longer for it to get economical? How does that work?
I think it will depend where you are. I think you'll still see solar, for example, in Texas.
Okay.
I think the people who are going to suffer the most is residential rooftop solar, but that's, I think, most dependent on subsidies today. I think utility solar will work in places of high electricity pricing and lots of sun. Wind, obviously, in areas with great wind. No great insight there. But I think you'll still see it, but I do think you'll probably see less because people will be uncertain what the regulatory regime will bring tomorrow.
There was a piece out in the Wall Street Journal coming down hard on you guys for accounting. And I'm wondering, A, well, what do you make of that? But B, do you think that there's a lack of confidence in the stock because of that? What's the reaction?
You know, there have been 2 articles and the stock went up both days that those articles were published. Derivative accounting is complex and not everyone understands it. Our investors are perfectly comfortable, our accountants are perfectly comfortable, our analysts are. We don't do very much speculative derivative trading. What we do is we buy derivatives so that if I have a 3-year power contract with you, I then deliver it to you. So it's in fact not really an open contract, but because financials are done annually, it looks like an annual contract. So from my perspective, I don't really understand those articles. I just think there's somebody's confused, and I don't think it's us.
All right. Well, we appreciate you answering the question and appreciate your time, Larry.
Thank you for having me. Appreciate it.
Larry Coben, the president and CEO of NRG Energy. And Alex, before we go here, seen a big spike in shares of MP Materials. This is basically the only domestic producer of rare earths. There is a headline crossing the wire here that the president of the United States is considering developing a plan to use Cold War era powers to prioritize and fund rare earth projects. Effectively, this would basically become sort of a military endeavor that would give them the power to sort of facilitate the production of these materials. You're seeing a big spike in the shares, up 9%.
I mean, we got critical minerals here. I don't know how many rare earths, though, we got here. So that's a different story.
Yeah, absolutely. All right, well, we'll dive deeper into that and get you some more details on that. Meanwhile, policies out of Washington also driving shares of GM and Ford, but to the downside, the possibility of renewed auto tariffs. That's coming up next here on The Close on Bloomberg. All right, time now for our stock of the hour. We're taking a look at 2, GM and Ford, down about 1% on the day, off the lows on the day here, but they had taken a big dip down after President Trump floated the idea of raising auto tariffs in the, quote, not too distant future. David Welch joins us right now, our Detroit bureau chief, to talk a little bit more about this. I'm a little confused. I can't remember exactly where we stand with the auto tariffs. What did Trump say today, and how would that change where tariffs are right now?
He said he may raise them again because he was successful in his view in getting General Motors to commit $4 billion to expanding production in 2027. Ford's committed to some more investment in the U.S. as well. And I think he sees he's got some momentum with getting companies to move their production back. And I think if you're the automakers, it's sort of the never-ending story, right? GM had already announced moves to try to offset $5 billion in tariff exposure with different moves. That didn't even count all the production they're going to move from Mexico to the U.S. in a couple of years with what they announced the other day. And if there are more tariffs or higher tariffs on parts and other things, that just puts Ford, GM, and anybody doing business in the car business in the U.S. Kind of back to maybe not square one, but back to trying to figure out how to offset costs for parts, vehicles, and the like. So it's just when they thought they were done with this, or maybe at least had done a lot to mitigate the damage and satisfy the Trump administration, there's a threat for more tariffs.
But on the flip side, there's also maybe some carve-outs or at least some ability to get aluminum and steel from, say, Mexico without that huge tariff rate. So, like, that could help in theory?
Yeah, look, there are some offsets for USMCA compliant parts and vehicles. And even some money coming back to USMCA compliant vehicles for a period of time. And that lasts a couple of years where you basically get a discount on the tariffs on the non-U.S. content. In other words, parts made in Canada or Mexico that go into vehicles that are otherwise compliant. It's a really complex formula, and Trump didn't exactly say how he would increase the tariffs, what it would mean for some of those offsets and some of those USMCA benefits that companies get by being compliant. It's just like Trump often does, he puts the idea out there, and so you know that something's going to be in the works. It could be a way to bargain with some of the companies, or countries rather, like Japan and Korea, where we don't have a new trade deal, and our automakers are still waiting to see what's going to happen there before they change anything with production. So maybe he's just trying to get leverage with them, but it's a threat, and investors and companies have to deal with it.
All right, David Welch, our man out there in Detroit here, the latest comments by the President of the United States regarding auto tariffs, pushing Ford and GM slightly lower. We should point out Trump was speaking at an event about terminating those California EV mandates, something he had promised to do on the campaign trail, and now he has apparently done.
Yep, and also just sort of raises the bar then that hybrids seriously will then be sort of the way forward. But what do you do if you're still producing and you still want to put money into EVs? Like, what you stop production? Is that what happens?
Yeah, absolutely. I just want to point out, too, just real quickly, a couple other big movers on the day. Remember, we had Chime, a new IPO coming to the market. Those shares up 38%. I also want to point out MP Materials. We just broke that news a little while ago. Those shares now up 16% on the back of that potential boost to rare earth discovery. Digging? Production? I don't know.
Yeah. All right. Well, we're about 15 minutes away from the closing bell right here in the U.S. We're going to take you to the closing bell.
Is your back hurting?
S&P, everything hurts, okay? The foot, everything. S&P is up 0.2%. Jordan Jackson, global market strategist at JMP, will be joining us.
10 minutes until we get to the closing bells. Fractional gains on the S&P once again. Romaine Bostic here with Alex Steele.
All right, taking a look at the S&P as you were mentioning, up 0.2% off the highs, but nonetheless, you have the Nasdaq actually flat on the day. I did want to point out the biggest gainer, which is Oracle, which was so interesting because the initial reaction was down on earnings yesterday, but then once we got that growth really coming through to the market, the stock had a super nice rally. But you know, it's not really widespread. Whatever movement we're seeing, we're looking at the Russell down 0.5%, and that and the transportation index not doing much either.
Yeah, kind of interesting. Oracle really turning out to be one of the big stories of the year. We should point out the biggest decliner to the downside. We do need to mention it is Boeing shares are down about 5% on the back of that horrific accident that occurred earlier this morning, U.S. time. As far as some of the other movers, Coinbase, Warner Brothers moving to the downside. And you're actually seeing a bid come into a lot of the healthcare stocks as well as a lot of the gold stocks.
Safety trade. The
safety trade there, and you can see yields down here on the day. So too is the dollar, though the VIX is elevated back at that 18 level as we count you down to the closing bells with just about 9 minutes to go. Jordan Jackson joins us here in Studio 2, Global Market Strategist at JPMorgan Asset Management. All right, Jordan, great to see you here. We've been talking a lot here about this climb in the S&P. We're holding that 6,000 level, and everybody wants to know, do we get back to that all-time high, 61.44 and change? What gets us there if we do get there? And more importantly, was this sort of path from that low in March to where we are today, was that even justified?
Yeah,
it's a lot of questions there.
It's a lot of questions.
Take whichever one you want. Yeah.
Well, you know, I think over the near term, we should expect a bit of choppiness. Like when you consider where valuations are, you consider how far and how fast the market has come since the bottom in April. You know, the markets are really poised for perfection right now. Any sort of deterioration in these trade negotiations that are happening, some concern, maybe another leg higher on the back end of the curve, depending on the price tag of reconciliation working through. Now the Senate has to push through their proposal. But again, the markets are really priced for perfection. I do think there's a risk that we could see some volatility and choppiness over the course of the summer. That being said, I still think markets are going to have an all-time high when we look at the end of the year.
Yeah.
I think we can probably end the year somewhere between 63, 6,400 on the S&P.
Okay.
And so I think there's some further upside for the balance of the year.
I am curious about that. I mean, right now, the Bloomberg survey, the last Bloomberg survey, which was taken sort of early last month, the average price target of the strategist that we track was at 6,100 roughly, I think. That's most likely going to go up when the new survey comes out next week. Some people are actually going a lot higher than that. They're above 6,500. We even had someone on the program earlier today on the network who was actually saying 7,000 over 12 months is not necessarily out of the cards.
Well, if you take a look, and we know markets are forward-looking, you look ahead towards 2026, arguably the bullish case is the trade negotiations will be behind us. Corporate America will have, figured out balance sheets, figured out costs, now back to a profitable environment. Consumer may be looking at some modest fiscal stimulus by way of reconciliation. Being able to expense R&D, domestic R&D, helping corporate America a little bit. This is a better 2026 environment, and in that environment, I could see the market continue to propel
Right,
higher.
so that's tricky. So in the short term, it's kind of safety trade, and then you got to get more constructive, right? So what's your safety right now?
Safety continues to be value stocks, defensives, gold, larger cap over small cap, right? The stuff that's sort of worked through the first 3-4 months of the year. And I think you got to be careful, again, where valuations are. The cheaper stuff is going to buffer a little bit better if we get another sentiment-driven, valuation-driven sell-off in the market, which we do expect over the near term. I do think there is still some concerns around the E in the PE ratio right now. There's been a lot of debate about, kind of this blended 12-month earning of about 270 on the E. Should it be 250? Should it be 300? There's a lot of wide-ranging estimates. But I think over the near term, there's some downside risk to earnings. Over the longer term, next 12 to 24 months, I think corporate America has been very resilient and been able to navigate a lot of this uncertainty. They're going to go back to earning money again, and that provides the bullish case for the balance of the year.
What about the bond market? Clip the coupon or stay away?
Clip the coupon. Okay, I wouldn't be looking at core fixed income as a total return asset class, i.e. yields are going to come down, you're going to get bond price appreciation. I really think this is a coupon. I think yields are range bound between 4.25% and 4.75%. I think we blow past on the downside 4.25% if we hit a recession. I think depending on the reconciliation price tag, we could see some upward pressure on that 4.75% level.
There's been a lot of discussion about the idea of reallocating outside the U.S., both the idea of foreign investors who were invested in the U.S. maybe pulling back, and U.S. investors maybe looking for, slightly better value overseas. Is that something that you recommend?
Well, I think to diversify, for those investors who are particularly concerned about debt risks in the U.S., term premium maybe continuing to grind higher from here. Looking globally, where arguably, while Europe is loosening up the purse strings, they've got the capacity to pull back if they need to. They got the political willpower to do so. I think it's better stated. As a U.S. investor going globally, though, depending on how you structure your hedging back to U.S. dollars, those forward FX interest rate differentials, you're getting a pretty nice pickup on the hedge premium right now, right? Because the Fed's been pretty down pat and staying patient, whereas you look at short-term rates overseas, that differential acts as a nice kicker for bonds.
I am curious, at least for U.S. investors here, or at least people invested in the U.S., are you really getting a true premium? And we talk about the lack of a meaningful term premium on the long end of the curve in treasuries, and even in equities, there's been, at least in aggregate, this idea that the equity risk premium isn't necessarily keeping up with historical averages. And it raises the question of, what would you buy? Like, if you're not already positioned in equities in some meaningful way, would you actually enter a new position at these levels?
Well, I think you got to be thoughtful about kind of valuations and where you're entering. I think, from a valuation perspective, small caps, again, and also time horizon matters as well. If you're talking about 2-3 years out, I think the valuations in small caps right now, I think, right on the bond side of the thing, the 2 to 3 year part of the curve is still, in my view, the sweet spot. Fed's still biased towards cutting rates. default rates remain low in corporate America. Maybe you tackle some spread products, some securitized spread on top of that. That gets you to a nice yield of around 5.5%, 6%. You clip that for the next 24, 36 months and are able to sleep at night. And I have a 10-month-old, so I don't really sleep too much already.
All right, well, we'll let you go and maybe get some rest here or get back to work. It all depends. Jordan Jackson, global market strategist at JPMorgan Asset Management, counting us down to those closing bells. Just about 3 minutes to go. The S&P fractionally higher on the day, led not by tech, but by utilities. So tech is the second biggest sector in the group.
And that's all Oracle at the end of the day, because that monster growth rate from cloud AI infrastructure.
Absolutely. To the downside, you are seeing a lot of the discretionary stocks weaker, as well as some of the industrial stocks as well. And we talked a lot today about the move lower in the dollar. Pretty magnificent, if you ask me, and not in a good way. But lowest level since 2022. Alex.
Right, and then you put that with the divergence between the 10-year and the dollar. If you put it between the 2-year, it's not as dramatic, that spread between the two. But the VIX is at 18. So, yeah, it's still low-ish, but it's picked up over the last couple of days despite modest moves in the equity market.
A full breakdown of all of today's market action, that starts now with our global simulcast.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now we are 2 minutes away from the end of the trading day. Romaine Bostick here with Alex Steele, taking you through to the closing bell with a global simulcast. It starts now. Scarlett Fu in the TV studio, and Looky Lou, Carol Massar and Tim Stenovic back in the radio booth as we welcome our audiences across all of our Bloomberg platforms and our partnership with YouTube. Great to see both of you here again. I'm not sure you missed a whole lot. It's been kind of a weird market action the last few days, and today certainly no different.
Yeah, it's interesting, right? The moves are kind of slight. I mean, we are holding on to our gains, and it looks like a little bit of an uptick here in the last few minutes of trading. But, you know, behind the small moves, there's so much going still on when it comes to certainly U.S.-China trade, whether or not the president is backing off certain policies when it comes to immigration. There's just so much churn, I feel like, in terms of news behind the trade.
Yeah, Eric Weiner was just on our program, and he shared with us a surprising technical, to me at least, which is, and I'll get the numbers a little off here, but approximately over the last 4 weeks, we've seen a 1% gain on the S&P 500, roughly. The 4 weeks before that was a 12% gain. So I won't say we've been treading water for the last 4 weeks, because 1% is nothing to shake a stick at, but taken in the context of the moves that we've seen over the last 8 weeks, hasn't been much.
Yeah, so it's a slow grind higher, climbing a wall of worry. I'll throw out all the cliches at you. But, you know, the other thing to keep in mind is we're talking about the weak dollar. The Bloomberg Dollar Index at a 3-year low, that's going to be a tailwind for so many companies in the S&P 500 that depend on overseas sales.
Well, here's the real question, guys. Carol, did you sit next to Tim when you traveled to San Diego?
I did. We actually sat side by side, and we survived. And
did you talk?
Actually, a little bit.
I only responded to her questions.
I did. I did fall
You only
asleep.
speak to Carol Massar when spoken to on an airplane.
Wow. All right.
Not that bad.
Well, I don't know. I don't know if this is related, but the main indexes that track airlines are lower here on the day by about 1%. Meanwhile, the rest of the market is in the green, with the Dow Jones Industrial Average up about 100 points or 0.25%. The S&P 500 continues to sort of inch higher, up about 23 points or 0.4%. 6,045 and change is your closing number. The Nasdaq Composite up 0.25% point. The Russell 2000, that's your main laggard, down about 8 points or 0.4%.
All right, so let's dig into the S&P 500, guys. Not quite an even split. Scarlett, actually 300 names to the upside in the S&P, so a little bit more of a bullish tone. Can I even say that? 201 names to the downside, 2 unchanged.
Yeah, that's fair to say. You look at the IMAP and it kind of shows up that way as well. You've got 8 sectors in the green, led by utilities, where 30 out of 31 big cap utilities finished higher on the day. PG&E is the exception there. Tech lifted by Oracle.
That's always a good sign when utilities lead the charge, right?
Yeah, but then you also have tech leading the way too, largely on the back of Oracle, but still tech and utilities. Maybe they're both safety trades because, you know, big cap tech. And then healthcare up 0.8%. The laggards of the day: communication services, consumer discretionary, and industrials.
Very interesting. All right, so let's get to some of the individual gainers. Hey, Oracle, that is your number one gainer in the S&P 500, finishing the day with a gain of more than 13%. Company reported fourth quarter results that beat expectations, and they projected a 70% gain in cloud infrastructure sales this fiscal year. So really giving a bullish outlook. You okay?
Yep, all good. Sorry.
Okay, good. No, that's okay. Giving a bullish outlook for the closely watched business. Stock, by the way, is up more than 20% year to date, so definitely an outperformer. Datadog, I don't know. For some reason, when I say Datadog, I think of you, Romaine. Don't you like this name?
Okay. I don't know where you're going with that, but yeah, let's continue.
Datadog. You always talk about Datadog. No, I didn't mean it. Do not read anything into that.
I read everything.
I know. No. Sometimes a cigar
he has
is
a dog.
a cigar.
I do.
He has a dog.
Yeah.
I do.
Okay.
Wonderful.
So maybe
Is it
that's
called
it.
data?
No.
Oh, that'd be funny.
She's called Carol.
Number one gainer in the
Okay.
NASDAQ 100. All right, moving along. Up about 3.5% in today's session. Wolf Research upgraded the software company to outperform from pure perform. They say it's one of the best positioned names in their coverage to benefit from AI adoption from both an adjacent, more workloads to be observed, and direct new AI offerings point of view, according to the analyst Alex Zukin. Price target at 150 a share, and so the stock closed at 122 and change. So some upside certainly there, according to Wolf Research. Cardinal Health 4.5%. This was a top gainer in the S&P 500. Shares hit a record here today after the healthcare distributor boosted adjusted earnings per share guidance for the full year and gave long-term growth targets that impressed Wall Street. Stocks up about 35% year to date. I know it was a record intraday, so okay.
Can I just add a couple honorable mentions?
No. I have one more.
Wow.
Shine.
Okay.
Shine Financial, which
Okay.
I was assuming you were going to get in there. So I asked Finley, if I could add this into. I know that was going back. Finley, if I could add a fourth name. Shine Financial, guys, up as much as 66% in IPO today, finishing the day with a 37% gain. We're talking about an IPO that went pretty well, priced above a marketed range. So, doing pretty well. What are you going to add?
I'll add another honorable mention. That was my honorable mention, by the way. I'll just add MB Materials having a great day, up 14% on the back of that news about a potential loosening of rare earth rules here in the U.S. Tim?
All right, let's do decliners. I got my eyes squarely focused on the tragedy that happened in India earlier today. Watching shares of Boeing down 4.8% on the day, fell as much as close to 6% earlier in the session. 787 Dreamliner traveling from India to London's Gatwick Airport crashed just shortly after taking off. This was the first ever complete loss of a hull of a 787. It's a plane that's more than a decade old. It's got advanced lightweight composite materials that improve fuel efficiency. There's about 1,150 of these jets in service, just an absolute tragedy. 2025 is right now one of the deadliest years in the past decade when it comes to civil aviation. Also affecting...
And I just want to point out, Tim, we
ahead.
are actually waiting for a press conference from the U.S. Transportation Secretary, Sean Duffy, on that.
Yeah, we're going to dip into that one on radio, too, when he does start to speak. Shares of General Electric now doing business as GE Aerospace, the engine manufacturer, down 2.3%. These were the engines that powered that 787 Dreamliner. They're the Gen X 1B engines. GE Aerospace actually is going to put together a team. They're going to go to India to analyze the cockpit data of that 787 Dreamliner. This according to a report earlier from CNBC. Once again, GE shares down 2.3% today. And finally, how about some Pokemon trading cards? Because that's what GameStop is saying is the future. Shareholders not loving it, falling 22.5%. What's that?
Not Bitcoin?
Not Bitcoin. I guess this week it's growing trading card business. Ryan Cohen said at the company's annual shareholder meeting, he's the CEO, that GameStop will focus on growing its trading card business. The business of Pokemon and sports trading cards is in line with our heritage. It fits our trade-in model. It appeals to our core customer base, and it's deeply embedded in physical retail.
Adobe earnings crossing the wire. Looks like a beat and raised quarter. Revenue up about 11% here at $5.87 billion. The street was looking for 5.8 even. Adjusted EPS coming in at $5.06 a share. The street was looking for $4.98. The company's guidance here for the third quarter, this says revenue will be in a range of $5.88 to $5.93 billion. The low end of that range is the average of street estimates. The company also says digital media revenue, a key metric now, of course, given everything going on with AI, 4.37 to 4.4 billion. And once again, the low end of that range is effectively the average of analyst estimates. You see that reaction in the shares, up 6%.
So the big question is really how the company really frames what's going to happen once its price increase comes into effect. It announced it back in May. It takes effect, or took effect June 17th. Takes effect June 17th. I'm getting my dates all wrong. But that's a big question mark because you've got upstarts like Figma and Canva that can take away some of the casual users, but the enterprise users will probably stick with Adobe. And how much will we see that really jump in the revenue line?
All right, guys, just a quick check in here on the bond market as we're waiting for more earnings to come out. RH, one of them is Joby trickles out as well. Buying across the curve, what was really interesting here is that we are off the lows of the session when it comes to the 2-year, despite those jobless claims and continuing claims, as well as that softer PPI. Also on the back end, we had that 30-year auction. Went all right. We got through the auctions this week. Everything worked out okay.
Yeah, so interesting to see. Hey, RH just starting to cross the Bloomberg terminal. Company saying it still sees fiscal year revenue of up 10% to up 13%. Keep in mind, as we wait for some more numbers to come out, this one's been beaten up big time year to date. It's down about 55% with almost 21% of the float shorted. So any outperformance, we could see some short covering, but we'll see, because right now we are seeing the stock bouncing around just up about 0.4%. Anybody else?
No, sorry, I'm just trying to dive in, of course, into the RH earnings shareholder letter here. They don't actually release the numbers in a sort of clean fashion, so it'll take us a moment to get to them. But it gets to this idea here. We talk about kind of the dichotomy between what we're seeing on the business spending side when it comes to Oracle, when it comes to Adobe, and, of course, what we see on the consumer side when it comes to RH, at least luxury consumers. Alex Steele, a big fan.
Oh, yeah. Yes. Romaine loves the RH. Sees second quarter revenue growth of about 8 to 10%. So those numbers coming in as well. And again, those full year revenue growth about 10 to 13%.
Yeah, exactly. All right, guys, that is a wrap. Our cross-platform coverage. Good to be back with all of you guys. We do it on radio, TV, YouTube, Bloomberg Originals. Alex is heading out. Scarlett and Romaine continuing, certainly on the TV side. Tim and I continuing here on Bloomberg Business Week Daily. Guys, we will see you all together, same time, same place, tomorrow.
And you want to stick around. Our coverage continues here on Bloomberg Television with a big focus on AI, a big focus on tech, a deeper dive into those earnings out of Adobe when we come back after the break. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostic. Two numbers, Scarlett, 60, 53, and 599. Those are basically the resistance and support points for the S&P 500. It's been pinned between that now for at least the last 8 sessions. And I guess the good news is that it's at least not falling below that support. 60.45 is your closing on the day, up about 0.4%. Once again, another day of fractional gains. But a few red flags to keep an eye on, at least when it comes to the cross-asset space. The dollar continues to weaken, down 0.6%, now back down to its lowest level since 2022. 30-year yields continue to drift lower. In fact, the entire curve drifting lower today. In fact, we're actually down on the 30-year yield this week by about 15 to 16 basis points. And again, given all the discussion about everything that's going on in Washington, there was an expectation you would see that move higher. And then a bit of a flight to safety with gold getting another bid here on the day, Scarlett. A spot gold up about 1%.
Yeah, so I don't know how much you can read into that lift in stocks if you have gold up by 1% on the day and the dollar weaker. All right, let's take a look at some individual movers. And we have the automakers all down on the day with GM. Excuse me, that should be GM, but that's incorrect. I put in the wrong ticker there, leading the way lower. And this is really on the back of President Trump saying that he might increase auto tariffs above the 25% level already, put out there in the not too distant future. So I know that's really vague and not specific, but his rationale is the higher the tariffs, the more likely it is that these automakers will move factories back to the U.S. or build factories here. And of course, the biggest gainer here, thank you for fixing that for me, GM down 1.2%. Oracle, the biggest gainer in the S&P 500, rallying by 13%. This is a record high here for the stock after it gave a bullish outlook, 70% sales growth this year in cloud infrastructure. And let's take a look at Adobe in after-hours trading. This is the creative software company, up marginally right now by 1/3%. The second quarter numbers, both on the top line and bottom line, beat analyst estimates. And for this quarter, the outlook for sales was really a range, and the midpoint of that range did top analyst estimates. Romaine?
Absolutely. And the CEO saying in that statement that, quote, they continue to invest in AI innovation across all of their customer groups. Gil Luria joins us right now, Managing Director and Head of Technology Research at D.A. Davidson. All right, the numbers look good on the surface here, both in terms of what they reported in the quarter and at least their outlook going forward here, Gil. I am curious about this idea of the investment in AI. How much progress you think they've made on that and how additive that might be to the bottom line going forward?
Well, I think it's going to be very additive. If you think about that creative suite that Adobe provides,
The critical part of that is the image generation, the video generation. And we think that Adobe can capitalize on all the innovation and the progress to make those products a lot better. Adobe has had a very thoughtful approach about creating its own tools using generative AI, but also allowing their customers to incorporate the latest and greatest from the model companies, from OpenAI and Midjourney and Google in order to make their products better. So we think AI is going to be accretive to them. They're already adding hundreds of millions of dollars of revenue. It's contributing to more than $1 billion of revenue. And we expect that to continue, which is very contrary to the narrative around Adobe. Somehow Adobe is getting snagged as an AI loser. We think that's a misunderstanding of how the technology works. The technology can generate the image. It doesn't help you with the collaboration. It doesn't help you with the editing. It doesn't help you with the publishing. That's what Adobe does for its customers.
That's certainly true. I mean, just to play devil's advocate here, I mean, there have been a lot of people, and I'm not one of them because I don't use it in that capacity, but for the creatives that I do know, and when they use Firefly and use some of the other tools, there's been a lot of concerns that, at least in their minds, their view, that it's just not good enough. I understand that they may not have a choice to use it because that's what they use in their jobs and their corporations, but the question is the quality going to hold up to keep those people tethered to the product?
It's going to hold up for the actual customer for Adobe, which is the companies, the enterprises. Of course, they see the value of the whole prospect of using Adobe, the workflows, again, the editing, the distribution. They care about more than just the generation. As a user, we may just care about the generation, but Adobe's customers are the companies that buy the software. And from their perspective, they just need it to work with whatever model is out there. And that's what Adobe has done. So even if you don't think that Firefly with Adobe generation is as good as Google generation through VO3, that doesn't mean that the corporate customer is going to shift to VO3. They'll just ask Adobe, hey, we want to use your creative suite with the image generation from Google. Right. So that's what makes Adobe so sticky. And that's why all these image generators will, over time, get incorporated into Adobe, and you as the user won't even notice that it's different.
Okay, thanks for explaining that. Gil, how much of a moat does Adobe have with its creative software for enterprise customers versus the more casual user like a Romain?
So the moat is entirely on the enterprise side because they're the default. They're the default application for marketing organizations and ad agencies. As a user, you may toggle back and forth, but when you show up to work and you turn on the computer, you're going to have the Adobe suite, you'll be trained on the Adobe suite, and you'll keep using it. That is precisely where the moat is. So you may, in your personal life, decide to experiment, but when you show up to work and turn the computer on, you'll be using Adobe, and the company will be paying Adobe for you to use that software.
Got it. And of course, all right, let's talk about the creative side when it comes to Figma. Figma was a company that Adobe tried to buy but failed to do so. So it's a competitor. Canva has also gained strength as well. So what are Adobe's competitive advantages over these two, especially with those that are not sticky users?
Well, those two companies are growing very fast, and we're very much looking forward to see them as public companies within the next few quarters. But Adobe has the opportunity and is working hard to improve the low end of its product base, the freemium products, the ones that you download, the ones that students use. And they're making progress there. But that is a true competitive thread that as Canva and Figma work their way up market, Adobe's going to have to continue to make sure that the free product or the low-cost product, the monthly subscription product, is at least competitive with those offerings. And that's Adobe's challenge. It's been catching up. But again, Canva and Figma are growing very rapidly, and they will be successful public companies one day.
Right. And again, casual users are the one most likely to experiment and just check out other offerings as well. Gil, thank you so much. Gil Luria is Managing Director and Head of Technology Research with D.A. Davidson. Adobe shares now down about 0.9% in after-hours trade. Coming up, we're going to speak with Wang. He is Chairman, CEO, Principal Analyst, and Founder of Constellation Research for his outlook on tech and whether AI will continue to drive investor interest. Of course, we did have an IPO today from Chime as well, a strong debut for that company. This is Bloomberg. We saw shares of Chime jump as much as 66% in their first day of trading after the company raised $864 million in an IPO priced above the marketed range. And this comes, of course, on the back of Voyager Technologies' debut yesterday. So the question is, are tech IPOs back? Let's ask Ray Wang. He is chairman, CEO, principal analyst, and founder of Constellation Research. Ray, is it fair to even call all these companies, Voyager Technologies, Chime, part of the tech ecosystem when we look at demand for tech IPOs?
We're at the edges of the tech ecosystem, but the good news is the IPO market is back, right? We had Circle, we had CoreWeave, eToro, and now we've got Chime here. And I think it's important. These are a set of fintech companies that were supposed to go public during the pandemic and didn't do that and had to recap, had to look at their models, had to cut costs, and now they're back. And it's a great signal for a lot of companies who do want to go public, all the way from, companies that have been waiting for a long time, including like Stripe. And so this is in the fintech category. What's important here is they make their money from interchange fees. This is what younger kids are using in terms of banking apps. They're not going to your traditional banks. They're going to Chime. They're going to Robinhood. They're going to other places to actually manage their money.
All right, thanks for answering that and putting that into perspective for us. So when it comes to the tech sector overall, what is our takeaway this earnings season when it comes to the integration of AI and whether that is truly paying off in a way that investors appreciate?
So here's the thing. Everybody invested a ton of money into AI. They bought a lot of chips from NVIDIA. And at the end of the day, we're all looking for revenue from AI. And this has been the challenge. But there comes Oracle, and you see what Oracle's doing is the infra play is still very hot. And what Oracle did, that's a great one to look at, is because on the Oracle side, they're able to actually get the cost structure down. And in some cases, when you go to Oracle Cloud Infrastructure, you're paying 1/5, 1/7 the cost of everybody else because they have a next generation cloud. And they've actually optimized all the things you could do to automate being in the cloud. And that's what gives them an edge. And when we look at all the other earnings, we had these, tariffs are going to crush earnings. People aren't going to buy. Well, the tech companies showed that people are still buying. There's a lot of strong demand, and they're also investing in the AI revolution.
When it comes to that AI revolution, and particularly with the possibility that we could see more entrants into the public markets in that space here, where do you think the most demand will be amongst investors? Are they looking for the companies that are actually building their own sort of LLMs from the ground up, or are they fine kind of looking at kind of these application stack companies just kind of putting something on top of OpenAI, ChatGPT, or whatever?
Romain, you're actually right. There's a couple categories. The first one is going 2 clicks out. 2 clicks out means you're going to software companies that are building agentic AI. Now let's review. Regular AI, classical AI, 2 + 2 = 4. Generative AI, 2 + 2 might equal 4, 98% of the time. And of course, agentic AI is 2 + 2 = 4. Now, what do you want to do with it? It's ushering an era of decision automation. And so the companies that are building agentic AI moats and actually enabling cross-platform agentic AI, that's going to be the companies you're going to bet on. ServiceNow, great company to bet on that. Salesforce, building that out. Workday, Oracle. These are companies that have agentic AI and continuing to build that out. Private companies like Boomi, Google, building the standards. Microsoft on the cloud side, enabling this to happen. Amazon on the hyperscaler side, also enabling this to happen. And that's the next bet. But there's also another category that's going to be on the horizon that is AI-first companies. These are companies with 100 people that are going to take on $1 billion software companies by rewriting the software game. These are services companies. You can have 1,000 people that are going to get to $1 billion in revenue that will challenge the Accentures and the Deloittes out in the world. And those are being formed right now.
Absolutely, and it's just kind of exciting because I felt like a year or two ago when we talked about AI, we basically talked about 2 or 3 companies because there was no one else to talk about. But you're now kind of seeing this all kind of become reality. I do want to just get your thoughts here on the juxtaposition between those companies that are spending a fortune to build out AI, like Meta, and then a company like Apple, which everyone's scratching their head trying to figure out, are they spending money on this? Do they care? Does it matter? I mean, this isn't going to be winner take all. But I do wonder if you're not in this now in terms of spending and building out, are you going to potentially be left behind once this really starts to hit critical mass in terms of usage?
Romain, you're absolutely right. You have to spend and invest to get there. And both these companies are doing different things. Meta is using AI to achieve operational efficiency. They're going to get to lower operating costs than everyone else. They've automated revenue operations. They've actually reduced the number of headcount, and they're actually allowing customers to take advantage of those efficiencies. Apple, on the other hand, is doing something different. They're trying to build AI at the edges. And what that means is, can I actually get that to a personalized experience? We weren't overwhelmed by their announcement, but what we did realize is you can do universal translation. You can actually automate tasks. There's a lot of interesting little features that deliver mass personalization at scale in the Apple model that you don't get anywhere else. And AI is going to move to the edges, and that's 3 clicks out. And that's what we're waiting for on the Apple side.
Ray, final question to you. This morning we heard that Micron is pledging $200 billion investment in U.S. manufacturing. It's the latest company to make this kind of announcement. And these are announcements that allow companies to score points with the White House. But I wonder if it changes their investment thesis. Does it make it more attractive, less attractive to investors?
It definitely makes them more attractive, but the index I'd be looking at is to find out which companies are going to get recommended and being suggested or approved by the amount of investment that's happening on the Middle East. That is like $5 trillion of investment, $2 trillion on the government side, $5 trillion on the private capital side. And if you're on that list, that is a growth factor. And if you can make that and actually tie that back to what's going on in the AI initiatives, that is going to be one revenue stream you don't want to miss, just like Stargate is for the U.S. government.
Hey, Ray, always appreciate you taking time for us. Always great insights. Ray Wang, their chairman, CEO, principal analyst, and founder over at Constellation Research. As we continue our focus this hour on tech and specifically AI. Coming up, we're going to have a conversation with Chris Holes. He's the founder and CEO of the location tracking company Life360. You know it for those tile things, but they've really expanded into a much broader ecosystem than that. And now they're making a big push into advertising. That conversation's coming up after the break. This is The Close on Bloomberg.
Location sharing platform Life360 is expanding, perhaps inevitably, into ads. The company this morning announced it's launching Place Ads, which is focused on behavior-based targeting, and Uplift, which analyzes foot traffic. So let's bring in Life360 co-founder and CEO Chris Holes joining us from California. Chris, the origin story of your company is fascinating because you actually go all the way back to 2007, 2008. You created this company in response to Hurricane Katrina to help families track each other. Tell us about how that evolved into a full-stack personal safety platform.
Sure. So when we started, I was in college. I saw Hurricane Katrina happen, and it was so hard for families to reconnect after emergencies. And it's right when smartphones were coming out. And we quickly realized we were onto something bigger. Facebook was getting huge with friends. LinkedIn was getting big for professionals. And we said, maybe the way to win families is really around coordination and safety. And we called the company Life360 because our belief was if we could make family life easier, if we could keep people safe, it would be really a way to be that super app for families and become one of the digital brand giants.
Yeah, my husband and I joke that it's an app that we use to stalk our kids to make sure that we know where they are. Apple's Find My and Google's Family Link came later. So how do you continue to differentiate yourself from those services which come in with a built-in user base and hardware?
So the results speak for themselves, and it's all about our focus on the family. Location sharing is a commodity. In the same way that every messaging app has photo sharing at this point, location isn't what makes us special. What makes us special is this experience for the family organizer. And when we say family organizer, we mean that intentionally versus saying a parent, because you might have a dog, you might have things, you might have aging parents, you might just be the person with a spouse that needs that extra help getting through the day. And there's a real need for that. Our average customer is opening the app more than 5 times a day, and we're having huge real-world impact. We're now the single largest source of driving data in the world, and we're detecting over 50,000 crashes a day and actually sending people ambulances when they can't ask for help. One of our main features people pay for is that service. We take the sensors on the phone, and we can really just help you. When that accident happens, we call 911 on your behalf. And that is what's really building that brand and differentiating us from the more generic products out there.
And I'm curious how you leverage that in order to sort of boost the bottom line. I mean, analysts are pretty bullish about your prospects for profitability over the next couple of years. And I am curious, is that through subscriptions? Is that through advertising? What is going to be most additive, most accretive to the bottom line going forward?
It's a combination. First, it always starts with our user base. We are growing very quickly. We're the 13th biggest app in the U.S. by DAU. We're now growing overseas. We have over 10% of the UK population using Life360 as one example. So the user base is growing quickly. Although we are strongest with families with teens, people would be surprised. We have people with grandparents, couples, even friends, close friends using the product. So we think we can double, triple, quadruple the user base. Subscriptions is growing. We have a hardware lineup. We're launching a pet tracker. We're launching an elder care product next year. And now it was just announced we're moving into advertising. Only about 1 in 8 of our customers pay a subscription. But if you can think of what we can detect in terms of life events and help people get products and services that are good for them in a privacy safe way, the advertising and data business could easily match our subscription business over time. And they're analyzing.
How do you I'm sorry to interrupt. Let me just ask you, how do you roll out that advertising in a way that, of course, doesn't turn off your user base? I mean, advertising is everywhere. Everybody sort of sees that as a way to keep, when you have a captive customer, to sort of put that in front of their eyeballs. How do you do that in a way where it's not, say, intrusive or offensive?
Sure. So our core focus is always on the free user experience. So we are not going to be a company that puts big interstitials or block you from using the app. We will not get in the way of jobs to be done. And what we want to do over time is really make our ads feel like they're not even ads at all. So one example that I'm really proud of, we now partner with Uber, where when you land at an airport, that's the time where you're going to want to get a car. It's a big race. So you're going to get the Uber, the Lyft, now the Waymo or the taxi. We say, hey, Chris, welcome to SFO. Do you need an Uber? Tap right here. And that will put you to the Uber app. That's making your life easier. And we drove over 100,000 rides to Uber since that product just recently launched. And there are a number of things we can do that take your data and actually help make the product better for you and not even feel like an ad at all.
Chris, you mentioned the Tile. That is your hardware. It's a tracking device. It's an AirTag predecessor that you acquired in 2022. They are made in China. So how have the imposition of tariffs, the pause in tariffs, the removal of tariffs changed how you are expanding your supply chain?
There's obviously a lot of uncertainty out there. Our Tile devices are primarily BLE devices, so Bluetooth. We don't really rely on them to drive hardware sales. It's really about selling subscriptions, and they're very low cost. So, of course, we would like a little bit more predictability, and it is increasing costs, but it doesn't really affect us in the way that a standalone hardware company might, where it's really all about the hardware margin. We are launching a pet tracking device later this year. That's a GPS device that was more impacted by tariffs. We are looking at diversifying the supply chain, but we did decide to do a primary launch overseas instead of the U.S. because we just did have that uncertainty to manage.
All right, good stuff. Life360 CEO, co-founder Chris Hulls. I just love the origin story, Romain, of how it came about because of Hurricane Katrina, and you know that was way before iPhones became the everyday device everyone uses.
Yeah, and it's I've used Life360 a lot. It's great overseas. I mean, we use, of course, Apple. Find
Are you stalking your kid on it?
Oh yeah, he knows that. I mean, that's the only reason he has a phone. But I mean, look, we're all parents, and we know obviously. The necessity of it as parents, but as he mentioned, also keeping an eye on a lot of us have parents who are aging out, and of course, so we need to be able to keep tabs on them and make sure that they're safe, and obviously pets as well. Yeah, I know you're a pet owner.
Yeah. So Datadog has
there
one.
There are a lot of uses for this. Yeah.
Romain's dog's name is Datadog,
Yeah.
or he won't tell me the dog's name, so I call his dog Datadog.
Just Wolf.
Wolf or Datadog. All right, let's take a look at how markets closed on the day. Another day of fractional moves. I mean, you add them up, and after a while, they do mean something. But as you were saying earlier, we're very much stuck in this range. So right now, up 0.4%, 60.45. It's yet another day of these small moves. What we did have was a really strong bond auction.
Yeah, and the bond auction, I mean, you had two really good. I mean, a lot of people were concerned about the 10-year yesterday and the 30-year today, and both came in basically, we'll just call it above expectations
which is
here.
Really great
which
these
shows
days.
that there's demand. And I don't think anyone was expecting a huge drop-off in demand. Remember, a lot of the effects, whether we're talking about tariffs, whether we're talking about the budget bill, things like that, the impact of those has not hit. And it may not hit, or at least may not hit at the severity that people had priced in. And I think that's what is keeping the market on edge and keeping us a little bit range bound.
These are existential questions that won't be answered in the near term. You also had data that shows inflation. The disinflation theme is very much intact. So coming up, we're going to break down all of this, all these market dynamics with Omar Aguilar. He is CEO and CIO of Schwab Asset Management. Keep it here.
All right, keep an eye on some of the after-hours movers. Adobe's fractionally higher on the back of its earnings, and R&H having a monster day here in the after-hours trade, up about 19%. The company is seeing a tariff impact, but saying it's finding ways to mitigate that, moving some production to the U.S., some to Italy, and overall basically saying that it can continue to grow revenue by about 8 to 10%, at least for the current quarter, and 10 to 13% for the full year. A lot of questions also about the durability of consumer spending, and the CEO saying in the statement here that he has confidence that spending will hold up. So how does this sort of factor into some of the broad market moves that we've had as of late, and whether those broad market moves continue going forward? Let's pose that question to Omar Aguilar. He's Schwab Asset Management's CEO and CIO. And I do want to start off with the consumer, Omar, because we kind of came into today with earnings season, a mixed bag, certainly on the consumer-facing companies. Consumer sentiment numbers definitely dour, to be sure, though we are going to get an update tomorrow on University of Michigan sentiment, and we are expected to see a rebound. I am curious as to what you make right now of consumer sentiment, the effect on the bottom line, and more importantly, the effect on asset prices.
Yes, and as you know, the relevance of talking about consumers and the relevance of talking about consumption in general is that that's pretty much what is holding our GDP growth, and that's what's been, seeing the building, components of how we can maintain these, growth in our economy. In general, most surveys, would suggest that in aggregate, consumers tend to be more negative now, mostly because of the level of uncertainty they feel, going forward. They don't know what the implications might be for, inflation. They don't know what the implications will be on tariffs and prices down the road. And in general, that, consumption will probably be affected. We have not seen the actual data that reflect that potential reduction in consumption just yet. And in some cases, it also doesn't affect all the levels of consumers the same way. What we're starting to see, early in the year, this is even before, discussion on tariffs, is that delinquencies on credit cards and auto loans is starting to rise. That's a natural part of an economic cycle. But I think it's starting to just get even higher, especially in the lower end of the consumer. Now, what that means is that the top earners, those people that earn the most, that are the drivers of most consumption, they have not seen yet the impact of either inflation or potential tariffs. And that, to me, is what will probably make the difference in terms of timing when we're going to see the actual consumption numbers going down.
I am curious as to where you and your team think that tariff rate may land, because there's been a lot of talk about how there's all these big numbers floating around there, 50% this, 50% that. Nothing's really been implemented, at least not at that scale. And we're now talking about potentially that maybe when the dust settles, we might see average tariff rates across the board, probably more in the low double digits, so maybe 10 to 15% or so. Does that sound realistic? And if so, can the market, and more importantly, can consumers handle that?
Yeah, well, we have done a lot of work in here. We have looked at a lot of information coming from different analysts and different sources. And, the expectation and the distribution of outcomes, goes, it's pretty wide. But I would probably say in general, we'll probably stay in the low, single digits to just middle digits. So it's somewhere in between 7 or 8. And, maybe 15 to 17% on average tariffs altogether. Again, that's based on all the research and all the aggregation that we have seen on data. Now, what is relevant about this conversation is not necessarily how, the exact precise number might be. What is important is that the average tariffs as of 2024 was 2.5. So the impact that we're going to see is going from 2.5 to anything that is north of that. And I think that's precisely what corporations and in general, consumers will be preparing for. So the impact on how would that go, we have not seen yet in the market because, as you know, a lot of these trade deals tend to last at least 18 months to actually get them done. And therefore, a lot of this is in preparation of tariff implementation that may take a while. But, as you know, people prepare for them, which means that may create that exceptionalism of bringing prices higher, at the beginning, where, things may change down the road. And we saw a little bit of that dynamic between the CPI and PPI that we saw yesterday and today.
Yeah, absolutely. When I look at the S&P 500, we were remarking earlier about how it's kind of stuck in this range, even with this slow melt up over the last 2 weeks. It's still not quite at that record high, and it has trouble getting to that point. What's the catalyst that's going to get us past that record high? We know that tariffs are not going to be resolved anytime soon. The Fed's not going to be cutting rates in the near term until it sees firm evidence that the economy is deteriorating. So what is it that's going to get people to push it up?
Yeah, well, great questions. We established these sort of dynamic of looking at, what are the reasons why we're in this range. And I would probably say we have been in this range for equities and for bond yields also now for the last several weeks. It was not until today, and that's one of the uncertainties that went away, which is, what was going to be the result of that 10-year, 30-year auction that ended up being very positive. So that, in my mind, you can say, all right, that uncertainty goes away. People were really concerned about that this was going to increase the term premium so high that was going to have a negative impact on the stock. So I think we just took care of that. We still have budget negotiations. So I think the process of getting through a budget, component may be a catalyst for things to become a little more clear down the road, because, the deficit discussion, the components that had to do with the expectations of what these do for inflation down the road will probably just go away. Yeah. And then the last thing I would probably say is, yes, a little bit more certainty about, the direction on these negotiations that are going on with different trades and trade policy will probably get, because, as I said earlier, the CPI PPI dynamics suggest that the consumers are starting to just not feeling yet the effect of tariffs, but producers, meaning the cost, is still absorbed already by companies. So that component of pushing the prices out to consumers is probably going to be down the road, and that may be another catalyst that will change the direction of the market.
Omar, final question to you. What's the one thing that you think investors have not priced into the market yet? The one thing that could trigger a negative reaction?
Well, in terms of, the level of uncertainty, markets, I think, is still fairly optimistic about the decision of central banks. I think, people seem to be very comfortable thinking that Federal Reserve will basically make at least 2 cuts before the end of the year. What it will happen and will be a negative surprise for the market is that all of a sudden we end up the year without a cut. And I think that in itself could change, because what is priced in the market is that at least we're going to have two rate cuts. And a lot of that may be as a result of where we are in the labor market. So I think, the direction on inflation seems to be in the right path. Earnings seems to be going into that direction. In fact, most companies seem to be, lowering their expectations to make sure that they stay with the level of uncertainty. But certainly markets seem to be fairly confident that the Fed will take action. And if that doesn't happen, that may create more volatility.
All right, good stuff. Omar, thank you so much. Omar Aguilar is Schwab Asset Management CEO and CIO. Meanwhile, U.S. household net worth is falling for the first time since 2023, and the culprit is that $5 trillion tariff-fueled stock market sell-off that took place in the first quarter. Of course, a lot of that has been recovered. So let's bring in now Sean Pyles, host and producer of Nerdwallet's Smart Money podcast. He is also a certified financial planner. When we look at that U.S. household net worth number, of course, that's a snapshot of a moment in time. If you were to look at it live, it'd be a different picture. But I want to start on inflation, because that's been the theme of this week. And the data that came out this week shows that we are clearly in this disinflation trend. How much does that trend reflect what the listeners on your podcast are feeling?
We're seeing some mixed results between how people are feeling about inflation and what some data is showing. Overall, trends that we know are that consumers experience these top-line numbers around inflation differently than what we actually are looking at in numbers. So, for example, over the past year, prices are up 2.4%, which is a great improvement from the high inflationary period that we saw a couple of years back. But it's a little bit mixed. Last month, we saw gas prices down 2.6%, although, of course, we saw some prices rise today. And then last month, groceries rose 0.3%, which is relatively fast. So consumers are feeling a bit of relief in some areas and inflationary strains in other areas.
It's interesting. We were supposed to get those Michigan consumer sentiment numbers tomorrow, expected to see a bit of a rebound after several months of declines. And it gets to this idea, Sean, of how quickly can consumer sentiment shift? I mean, if we start to get more good news or maybe less bad news, is there sort of a direct effect, meaning that all of a sudden people do feel confident digging into their wallets, or is it a little bit more complicated than that?
It can be a little bit more complicated than that based on what individuals have going on in their own lives. You're right that we've seen consumer sentiment really fall off a cliff this year. It stabilized slightly last month amidst frequently changing policies. The latest data that we have from last month says that it's not getting worse, but it's not quite bouncing back either. We will see what tomorrow has to show for that. Over the year, consumer sentiment is down over 24%, and it's near record lows, and that may make people want to pull back on their spending and hopefully save some more money.
So consumer sentiment obviously is a measure that you watch closely because it does, come from your listeners and individuals themselves. I'm curious, in terms of the data points that we cover every morning here on Bloomberg, which data points have little or no resemblance to what your listeners are feeling?
One that we're seeing is how people are managing just day-to-day inflation. Again, it goes down to individual areas where consumers are putting their money. For some people, if they're living in a city, a drop in gas prices may not really affect their day-to-day experience of navigating their finances when they're seeing groceries continue to increase. So it speaks to how individual the experience of inflation is. And this is still before tariffs have actually begun to impact inflation, which we have yet to see play out.
When people ask you for advice, particularly when it comes to whether to continue spending, particularly on discretionary items. When you look forward into the rest of the year, should I actually plan that vacation or maybe just, do a staycation? Should I buy that new car or just keep the one that I have? Do you have a general sense with regards to economic conditions of being confident and being able to say, yeah, do this or do that? And I'll put the asterisk that I know every single person's situation is different.
Of course. So right now I'm thinking about the uncertainty that we're all experiencing as a storm cloud on the horizon. It may come this way, it may dissipate, it may go elsewhere, but we see something that makes us feel a little bit nervous. So for anyone that's seeing this, it's smart to pull back on some discretionary spending and really focus on saving. We know that there's never an ideal time to reduce discretionary expenses, and summer is really not an easy time for this, as many families are preparing to hit the road for vacations. But guess what? Before we know it, we're going to have holiday expenses here. So before folks pack their bags for any summer travels, it's important to take stock of your spending, see where you can cut back and beef up on your savings. And speaking of summer travel, we did get a good piece of news from yesterday's PPI report, which is that airfare and hotel prices continue to decline.
Absolutely here. And we should also point out, at least on a year-over-year basis, gasoline prices also lower, though certainly elevated over the last couple of months. Sean, always great insights out of you and the team over at Nerdwallet. Sean Pyles hosts Nerdwallet's Smart Money podcast. All right, stick with us. We got a little bit more coming up here on the close. We're going to set you up for what the markets will have their eyes on over the next 24 hours. This is Bloomberg. All right, let's set you up for what the market will have their eyes on over the next 24 hours. Some interesting interviews with some big auto executives, including at Ford, Hertz as well. This is Bloomberg News. Matt Miller, who somehow talked himself into a trip to France, 24 hours of Le Mans.
Well, the Le Mans race doesn't begin until Saturday, but our coverage kicks off tomorrow. So there's a full lineup of extraordinary auto industry guests starting in the 9 a.m. hour.
Yeah, so we'll have to get some insights too. I mean, obviously there is a lot of serious stuff going on. And of course, a lot of talk about tariffs and other things as well. Meanwhile, back here in the U.S., we are going to get an update here on the University of Michigan consumer sentiment and inflation expectations.
Remember when this number really moved the market?
Yeah.
Because it took a dive because of all the tariff uncertainty?
Yeah.
Well, this time around, this is for June, when it comes to sentiment, current conditions, and expectations, we're expected to see an improvement because things have calmed down so much. And inflation expectations are expected to drift lower as well.
Yeah, just slightly, and that's a good sign here. And there's been a lot of talk as to maybe how fast the consumer has snapped back now that some of the tariff rhetoric has tamped down a little bit. And if you're a sports fan, the NBA Finals, Game 4 tonight at 8:30 p.m. Eastern Time.
Who are you rooting for, Ian?
Neither really, but I don't know. It's kind of, I guess, the Pacers, but it hurts me to say that being from Chicago. We'll be back tomorrow. This is The Close on Bloomberg.